Hello, investors and traders, and welcome to the weekly market report with the Market Guys. I'm AJ Monty. This is a one-year daily candle chart of the Dow Jones Industrial Average ETF, ticker symbol DIA. And if you've been following along each and every week, you'll know that I leave my lines on the chart from the previous week's forecast so you can see just how accurate technical analysis is when used as a forecasting tool. So to recap what I said last week, this here was Monday, Tuesday, Wednesday, Thursday, Friday. Right here is Friday. I said that we would most likely move lower to fill this gap and test support, which, by the way, is a gap fill support level. And let me just zoom in a little bit more so you can see again how accurate this is. I said we would move lower and we would most likely see a bounce off of the support, which is why I have that little V there. You see, that's called a pivot point. And look what happened. Thursday, we went down to pennies of that support level, and we bounced just like I said we would. Now, what does this mean for next week? Well, there's a couple of clues here that tell me we could move a little bit higher early in the week, but I don't see the buyers coming in with force. Yes, this is a significant long green candle that we see right there, but if you look more closely at the very bottom, you'll see that there isn't a whole lot of volume that supports that upward move by the buyers. So a drop in volume tells us that it's more or less a weakening of that buying activity. So for next week, I think that we will actually move up Monday and Tuesday, maybe even break over this resistance right here, but I'm going to draw that resistance so it remains clear for you on the chart. And then after we test that resistance, my forecast continues just like this. And I think we will most likely pull right back to stay within this trading channel, more or less, between support and resistance. So that's the diamonds. Now, if we look at the Qs, which is representing more of the NASDAQ shares, I said that we would most likely move lower, and I drew my line right here. I said we would most likely move lower towards the end of the week, with the end of that line being my target. But before we moved lower, as I said last week, we would most likely move up first to test that 20-period moving average. So you see, I drew this line first. Look at that. On Monday, we went right to that pivot point and then came down. Interestingly enough, the high and the low for Monday has really covered my range for the forecast last week, and then we bounced. So like the Dow, what does this mean? Well, I think we could move just a little bit higher to test resistance right here. And then after we reach resistance, I think the buyers are going to get even more tired, and we will most likely see a pullback. And there's some other clues that I'm seeing in the market that tell me that we could see lower towards the end of the week, and I'll point that out to you here shortly. But again, I'm going to draw that just like that. Again, we have a lower volume day on that green candle, which tells us that the buyers are weakening. Here's why I think the markets are eventually going to pull back. And I'm going to go to the VIX as our leading indicator. Again, if you don't follow the VIX, I think it's a good idea to keep it on your watch list, because the VIX is actually a leading indicator. It measures volatility. We also call this the fear gauge. And so when the market is more or less set up to pull back, we will generally see a rally in the VIX first. And we have a red candle on the VIX. Now, remember, my forecast for last week was that we would most likely move up on the VIX and possibly breach this resistance area. That's why I drew that end of that line being my target, a little bit over that resistance area. And if you want more evidence, just go back to last week's report so you can see exactly what I drew on the chart and what I said from last week. So we did that. We went over that resistance line on Thursday, and then we pulled right back. Now, this is a red candle. I'm going to erase all these lines and make this very clear for you, because here's what's happening. The VIX is contrarian to, and more or less it's a contrarian indicator to, the S&P. And I'm going to get to that one next. If you look, we have a support level right here. There is a good chance that the VIX will rally next week, and so I think that we will draw my forecast just like that. But next week, I think that we could actually break over or break out of resistance. But this time, I think we're going to stay over that one for a little while. So keep your eye on the VIX. Now the S&P, here we go. It's a contrarian indicator. The VIX is a contrarian indicator of the S&P. We moved very, very close, within pennies of my target right here. We did that on Monday. And then yesterday we had a bullish engulfing pattern on the S&P. Now I don't want you to get confused on this, because remember, the VIX is a leading indicator for the S&P. But the way this is panning out, that bullish engulfing pattern might lead us just a tad higher on Monday and Tuesday, and the VIX could actually stay right where it is as the market does this. And then I think later in the week we're going to pull back. So let's leave those lines in place for next Friday, and we'll look at it from there. And finally, I'm going to look at the Russell 2000. This is a more broad-based index. Obviously, it tracks 2,000 stocks, unlike the S&P that tracks 500 and the Dow 30. But you see here that we have, again, an upward leg right here. We did move lower, like I said. We bounced off a support right here. I'm going to erase that line to make the chart clearer for you. I think the VIX could go just a tad high, just like the rest of the markets, and then come right back down. Here's why I think that will happen. Right here from the highs in June, that's June 21st highs, you'll see there's the high. And then later on in July, we see a slightly lower high. And this is also followed in July, later in July, with another high, but that is also lower. So we're seeing successively lower highs here. That's why I think we'll still rally a little bit on the Russell 2000, but ultimately I think we're going to set a lower high from these highs back here. So keep your eyes on the chart. This more or less tells us not to get too aggressive with any new long positions. I'm not saying don't buy any stocks. I'm just saying be very careful. Technical analysis is not just a forecasting tool. It's also used as a risk management tool. It's actually tells us where we could be setting our stops below support levels. If you'd like to learn more about what we do with the Market Guys, just go to the Market Guys website, and there's a link right there. See that tab? It says videos. Click on that, and it will bring you to a library of videos, very short videos that we call market shots. And you'll see you can scroll through here and really look at how we trade using these signals. I would pay very close attention to the 1% rule, because just as I mentioned, the charts are also a very good risk management tool, but you have to learn how to set your stops correctly so that you're not setting yourself up to suffer a catastrophic loss. And that's what we do here at the Market Guys. We teach people how to make money by losing very little when we're wrong, and that's the name of the game. So have a great weekend, and we'll talk to you soon. So long.
This video segment is a small part of what the Market Guys offer through their educational products and services. If you are interested in any of our Trade Alert services, or you would like more information about our one-on-one mentoring program, simply contact us at info@themarketguys.com.